The information provided in this video is for educational and entertainment purposes only. It does not constitute financial, legal, or professional advice. Auto repair loans, personal loans, and credit products involve significant financial commitments, interest rates, and potential impacts on your credit score. Every individual's financial situation is unique, and historical trends or case studies discussed do not suggest potential outcomes for your specific circumstances. We strongly recommend that you consult with a certified financial planner, a licensed credit counselor, or a qualified professional before making any significant financial decisions. Conduct your own due diligence and read all loan agreements thoroughly before signing. You are sitting in a cramped, poorly lit waiting room that smells like industrial degreaser and stale coffee. Across from you, a mechanic in grease-stained coveralls is holding a clipboard, and he just gave you a number that feels like a punch to the gut. $3,412. Your car, the vehicle you rely on to get to work, to drop the kids at school, and to navigate your daily life, is currently a 2-ton paperweight. You do not have $3,000 in your savings account. In fact, according to recent economic data regarding the American consumer, nearly 60% of adults in the United States cannot cover an unexpected $1,000 emergency expense with their savings. You are not alone, but that realization does not fix your transmission. The mechanic sees the blood drain from your face and offers a solution that sounds like a lifeline. He says they offer in-house financing, quick approval, low monthly payments. Just sign here, and we will have you back on the road by tomorrow. Feels like the universe just handed you an escape hatch. But before you pick up that pen, you need to understand that you are standing at a massive financial crossroads. What feels like a simple repair loan could actually be the first step into a debt cycle that lasts longer than the car itself. Most people see an auto repair loan as a bridge to get them from a breakdown to a functioning vehicle. In reality, if you do not understand the mechanics of the lending industry, that bridge might be made of straw. The automotive repair industry in the United States is a multi-billion-dollar ecosystem that relies heavily on the fact that most Americans are one bad alternator away from a financial crisis. In this deep dive masterclass, we are pulling back the curtain on the 5 critical things you must know before you even think about applying for an auto repair loan. We are going to look at why these loans are structured the way they are, the hidden costs that the brochures never mention, and the specific data points that lenders use to determine how much they can extract from you over the life of the loan. This is not just about fixing a car. This is about protecting your financial future. Today, we are solving the problem of information asymmetry. Usually, the lender has all the data and you have all the desperation. We are flipping that script. We are going to explore case studies of how interest rates can vary by as much as 20% based on the type of lender you choose, and we are going to break down the step-by-step process of evaluating whether a loan is a tool for your success or a trap for your paycheck. Think about the last time you looked at your credit score. Now, think about how that score interacts with a high-interest personal loan versus a specialized auto repair credit card. These are 2 completely different financial instruments with wildly different consequences. If you choose the wrong one, you could end up paying back double the cost of the repair. Imagine paying $6,000 for a $3,000 engine job. That is the reality for thousands of drivers every single month, because they didn't know the right questions to ask at the service desk. We are going to dive into the world of annual percentage rates, or APRs, and why a low monthly payment is often the most dangerous number on a loan document. We will examine the data regarding subprime lending in the automotive space, and how certain predatory practices are hidden behind terms like deferred interest and processing fees. You need to understand that an auto repair loan is a high-stakes transaction because, unlike a mortgage or a traditional car loan, the asset being repaired is depreciating every single day. You are borrowing money to maintain a tool that is losing value, which creates a unique set of risks that most financial tutorials completely ignore. In the sections to come, we will provide a comprehensive breakdown of the 5 pillars of auto repair financing. We will look at the difference between traditional personal loans from credit unions, dealership-sponsored financing through major manufacturers, and the third-party buy now, pay later apps that have recently flooded the automotive market. Each of these has a specific profile of risk and potential outcomes. By the time we finish this deep dive, you will have a mental checklist that allows you to walk into any dealership or independent shop with the confidence of a forensic accountant. You will learn how to spot a deferred interest trap from a mile away. These are the offers that claim 0% interest for 6 months, but if you have a balance of even $1 remaining on day 181, the lender may back calculate the interest from the very first day at a rate that can exceed 29%. We will look at historical trends in the lending market to show you why these offers exist and why they are so profitable for the lenders. Furthermore, we are going to discuss the impact on your debt-to-income ratio. Taking on a high-interest repair loan doesn't just affect your monthly budget. It can prevent you from qualifying for a mortgage or a lower-interest credit card in the future. We will provide examples of how a simple $2,000 loan can lower a credit score by 30 points if it is not managed correctly, and what that means for your long-term borrowing power. This masterclass is designed to give you the leverage. You are going to see real-world scenarios where drivers saved hundreds, even thousands of dollars, simply by knowing how to negotiate the terms of their financing, or by identifying alternative ways to fund a repair that the mechanic didn't want them to know about. We are talking about everything from the psychology of the emergency sale to the technical details of loan amortization. If you are watching this because you are currently facing a massive repair bill, take a deep breath. The pressure you feel to make a decision right now is part of the system's design. Lenders know that a person with a broken car is a person who is likely to make an impulsive decision. Our goal today is to replace that impulse with an informed strategy. We are going to go deeper than any 30-second clip or surface-level blog post ever could. This is the definitive guide to navigating the complex, often murky waters of auto repair loans in the United States. We will start by analyzing the true cost of borrowing, moving into the specific types of lenders you will encounter, and then we will provide a step-by-step roadmap for evaluating any offer you receive. We will also touch on the legal protections available to you under the Truth in Lending Act, and how you can use that knowledge to ensure you are being treated fairly. By the end of this video, you will not just know how to pay for your car repair. You will know how to manage a financial crisis without letting it manage you. This is part 1 of our 10-part series, and we are starting with the foundational knowledge that will keep your bank account as healthy as your engine. To understand why an auto repair loan can be so predatory, you first have to understand the environment of the American garage in 2026. Imagine a driver named Marcus. Marcus lives in a suburb of Atlanta and commutes 40 minutes each way to his job at a logistics firm. His 2018 mid-sized SUV is his lifeline. One Tuesday morning, the check engine light flashes red, the transmission slips, and Marcus finds himself towed to a local repair franchise. The estimate for a full transmission rebuild is $5,400. Marcus has $2,000 in his emergency fund, which is actually higher than the national average for a household in his income bracket, but he is still $3,400 short. This is the moment where the pressure of the environment dictates the financial outcome. The service advisor at the desk sees the panic in Marcus's eyes and immediately pivots from talking about gear ratios to talking about monthly payments. This is the first thing you must know: the distinction between the cost of the repair and the cost of the money used to pay for that repair. Historically, service centers have shifted their business models to include high-margin financial products. When a mechanic offers you a loan, they are often acting as a lead generator for a third-party lender. In Marcus's case, the service advisor presents a branded credit card specifically for automotive repairs. He tells Marcus he can get the work started today with $0 down and a monthly payment of only $150. To Marcus, $150 sounds manageable. It fits within his monthly budget. However, what is not immediately highlighted is the deferred interest clause. Many of these specialized automotive credit cards carry an annual percentage rate of 29.99%. If Marcus does not pay off the entire $3,400 balance within the promotional 6-month window, the lender backfills the interest. This means on month 7, Marcus wouldn't just owe interest on the remaining balance. He would be charged interest on the original $3,400 from the very first day of the loan. In a case study involving similar financial products, a consumer who missed the payoff deadline by just 3 days ended up with over $600 in immediate interest charges added to their principal. The data suggests that nearly 30% of borrowers who utilize deferred interest promotions fail to pay off the balance before the interest kicks in. This is not necessarily due to irresponsibility, but rather to the way these loans are structured to prioritize low monthly payments over principal reduction. To avoid this, you must perform a step-by-step audit of the loan disclosure statement, specifically looking for the box labeled total of payments. This number tells you exactly what you will have paid after all scheduled payments are made. If the repair is $3,400 and the total of payments is $5,200, you are effectively paying an $1,800 premium for the convenience of that loan. For Marcus, that $1,800 represents nearly 2 months of his mortgage payments. By focusing on the monthly payment instead of the total cost of capital, He is unknowingly sacrificing his long-term financial stability for a short-term mechanical fix. Now, consider a different scenario with a character named Sarah in Columbus, Ohio. Sarah's car needs a new head gasket, a $2,800 job. Unlike Marcus, Sarah decides to look beyond the dealership's in-house financing. She investigates a personal loan through her local credit union. Historical trends show that credit unions often offer interest rates significantly lower than specialized retail credit cards, sometimes ranging from 8 to 12% for those with fair to good credit. By taking this extra step, Sarah secures a $2,800 loan at 10% APR over 24 months. Her monthly payment is roughly $129, and her total interest paid over the life of the loan is approximately $300. Compare Sarah's $300 cost of borrowing to the potential $1,800 cost Marcus faced. Sarah's proactive approach saved her $1,500, which she can now put back into her vehicle's maintenance fund to prevent the next breakdown. This brings us to the second critical point: the impact of the repair loan on your credit utilization ratio. Most auto repair loans are structured as unsecured revolving lines of credit, similar to a credit card. If your repair bill is $4,000 and your new credit line is also $4,000, your utilization on that account is 100%. This can have an immediate and negative impact on your credit score, potentially dropping it by 20 to 50 points in a single billing cycle. For someone like Sarah who might be looking to apply for a mortgage in 2027, this sudden dip could result in a higher interest rate on her home loan, costing her tens of thousands of dollars over 30 years. This is why you must ask the lender if the loan is a revolving line of credit or a term loan. A term loan, which has a fixed end date and a set number of payments, is often viewed more favorably by credit scoring models than a maxed-out credit card. You also need to be aware of the hard inquiry trap. When you are in the repair shop and the advisor asks for your social security number to see what you qualify for, they are often initiating a hard pull on your credit report. If you are desperate and allow 3 different shops to run your credit in one afternoon, those multiple inquiries can further damage your score. In the modern lending landscape of 2026, many fintech lenders now offer soft pull pre-approvals that allow you to see your potential rate and terms without affecting your credit score. You should always insist on a soft pull first. If a lender or a mechanic tells you they cannot do that, it is a significant signal to look elsewhere. Furthermore, let's talk about the collateral. In some high-risk repair loans, specifically those marketed to individuals with subprime credit, the loan may be secured by the vehicle's title. This is essentially a title loan disguised as a repair loan. If you fail to make the payments, the lender has the legal right to repossess your car. Imagine the irony: you took out a loan to fix your car so you could keep working, but because the interest rate was so high and the terms were so aggressive, you lost the car anyway. Case studies of title-secured repair loans show a much higher rate of repossession compared to unsecured personal loans. This is a high-stakes gamble that many Americans take because they feel they have no other choice. To navigate this, you must follow a strict sequence of evaluation. Step 1 is to get a written estimate for the repair, and then leave the shop. Do not sign anything while the adrenaline of the breakdown is still in your system. Step 2 is to check your existing credit lines. Often, a standard credit card you already own will have a lower interest rate than the emergency financing offered at the shop. Step 3 is to contact your bank or credit union for a personal loan quote. Step 4 is to compare the APR, the total cost of the loan, and the impact on your credit utilization. Only after you have these data points can you make an objective decision. But what happens when the repair costs more than the car is actually worth? This is a mathematical trap that traps thousands of drivers every year. You are essentially pouring money into a sinking ship, and the loan you take out to do it might outlast the vehicle's remaining lifespan. If you are financing a $5,000 engine for a car with a market value of $4,000, you are starting with negative equity. If that car is involved in an accident next month, the insurance payout will not cover the balance of your repair loan. This leaves you with no car and a multi-thousand-dollar debt. As we move forward, we need to look at the specific language used in these contracts. Words like origination fees, prepayment penalties, and administration charges can add hundreds of dollars to your balance before a single wrench has even touched your car. We are going to break down exactly how to read a truth in lending disclosure to find these hidden fees. But before we get into the fine print, there is a much bigger question you need to answer. Is the repair actually necessary for the vehicle's safety, or is the shop upselling you on preventative measures while you are in a vulnerable state? Understanding the difference can save you more money than any low-interest loan ever could. In the next part, we are going to look at the specific repair scams that often go hand in hand with these financing offers and how to verify that the work you are funding is actually required. The intersection of automotive mechanics and high-interest financing is a playground for predatory behavior, and it often begins with the diagnosis. In 2026, the complexity of modern vehicles, with their integrated sensors and proprietary software, has made it easier than ever for a dishonest shop to inflate a repair bill. Before you commit to a loan, you must understand the concept of the bundle. Imagine a driver named Elena in Phoenix. Elena's hybrid sedan has a malfunctioning cooling fan. The repair should cost roughly $600. However, when the service advisor sees that Elena is interested in their installment financing plan, the narrative changes. Suddenly, the cooling fan is part of a critical cooling system failure that requires a complete radiator flush, new hoses, and a water pump replacement. The total jumps from $600 to $2,200. Because Elena is being offered a monthly payment of only $80, the $1,600 increase feels less like a financial hit and more like a necessary upgrade for her safety. This is a classic case study in upselling through financing. The first thing you must do to protect your wallet is to request a line item breakdown of the parts and labor before any mention of a loan occurs. In the automotive industry, there is a standard reference called the labor guide or flat rate manual. Every job has a specific number of hours assigned to it by the manufacturer. If a shop tells you that replacing a starter motor takes 5 hours, but the industry standard is 1.5, they are padding the bill to maximize the loan amount. Historical trends indicate that shops offering in-house financing often have higher labor rates or parts markups because they know the customer is not paying cash up front. They are essentially baking the risk of the loan into the cost of the repair. To verify the work, you should use a 3-step validation process. First, ask for the specific diagnostic trouble codes, or DTCs, that the car's computer triggered. You can look these codes up on independent databases to see if they align with the suggested repairs. Second, ask the mechanic to show you the failed part on the vehicle. A reputable technician will have no problem pointing to a leaking gasket or a frayed belt. Third, and most importantly, get a second opinion from a shop that does not offer the same financing product. Let's look at the data regarding unnecessary repairs. Independent consumer advocacy groups have conducted mystery shopper tests where perfectly functional vehicles were brought into shops. In nearly 40% of cases where financing was prominently advertised, the shops recommended at least one unnecessary service. This is why the financing offer itself can be a red flag. If a shop's marketing focuses more on no credit check loans than on their ASE certification, their primary revenue stream might be interest and fees rather than high-quality mechanical work. Consider the scenario of a character named David in Chicago. David needs new brake pads. The shop tells him his rotors are also warped beyond repair and suggests a 4-wheel brake overhaul for $1,200, conveniently covered by a 6-month loan. David insists on seeing the rotor thickness measured with a micrometer. When the measurements show the rotors are well within the manufacturer's safety specifications, the $1,200 bill vanishes, replaced by a simple $300 pad swap. By questioning the necessity of the repair, David avoided a $900 loan that would have carried a 24% interest rate. Another critical layer of this masterclass involves the psychological tactic known as the safety pivot. This is when a service advisor uses fear to justify a high-interest loan. They might say, "I wouldn't feel comfortable letting you drive your children in this car without these repairs." While safety is paramount, it is often used as a lever to bypass your financial logic. In 2026, many shops use digital vehicle inspections, or DVIs, where they send photos and videos of the repairs to your phone. While this looks transparent, it can be manipulated. A photo of a slightly dirty cabin air filter can be framed to look like a catastrophic engine failure to an untrained eye. You must learn to distinguish between a safety-critical repair, like a failing ball joint, and a maintenance-recommended service, like a transmission fluid exchange. A loan for the former may be a necessity. A loan for the latter is often a financial mistake. Now, let's talk about the specific financial mechanics of the add-on trap. Many auto repair loans come with hidden costs that aren't parts or labor. These include shop supplies, hazardous waste disposal fees, and administrative processing fees for the loan itself. In some case studies, these fees accounted for up to 15% of the total loan balance. If you are borrowing $3,000, you might be paying $450 just for the privilege of the shop's paperwork. You should always ask for these fees to be waived or reduced. Remember, the shop is usually getting a commission from the lender for signing you up. They have room to negotiate the price of the repair because they are making a profit on the back end of the financing. Imagine if you were able to negotiate the labor rate down by 10% simply by mentioning that you have an alternative line of credit. Shops prefer their own financing because it is more profitable, but they prefer a guaranteed sale over a customer walking away. This leads us to the concept of the cash price versus the finance price. In many retail sectors, including automotive repair, there is an implicit discount for cash. If you can secure a personal loan from an outside source like a credit union, as we discussed in the previous part, you can walk into the shop as a cash buyer. This gives you the leverage to negotiate the repair cost without the shop trying to recoup their margins through high interest rates. Furthermore, we must address the issue of the mechanical breakdown insurance or extended warranties that are often bundled into these loans. A service advisor might tell you that for an extra $20 a month on your loan, you can add a protection plan that covers future repairs. On the surface, this sounds like a smart way to avoid the next financial crisis. However, historical data shows that these third-party warranties have a very high rate of claim denial and often exclude the very components most likely to fail on your specific vehicle. By bundling the warranty into the repair loan, you are paying interest on a service that you might never be able to use. This is a double loss for the consumer. You are paying interest on the money used to buy the repair, and interest on the money used to buy the insurance. To avoid this, you need to follow a strict documentation protocol. Step 1. Obtain the itemized estimate. Step 2. Research the average cost for those specific repairs in your zip code using reputable online estimators. Step 3. Compare the shop's total with the estimator. If the shop is more than 20% higher, they are likely inflating the cost to compensate for the financing. Step 4. Strike out any non-essential add-ons or protection plans from the loan agreement. Step 5. Demand a written guarantee on the parts and labor that is independent of the loan status. There is also a growing trend in 2026 of tiered repair offers. This is where a shop gives you 3 options: a budget repair with used parts, a standard repair, and a premium repair. Usually, the financing is only available for the premium option. This is a subtle way to force you into a more expensive repair than you actually need. You should always push for the most cost-effective solution that maintains safety, even if it means searching for a lender who is willing to finance a smaller amount. As we deepen this analysis, we have to look at what happens after the repair is done. Most people think the transaction ends when they get their keys back, but with a repair loan, that is just the beginning. The way the interest is calculated, the timing of your payments, and the way the lender reports to the credit bureaus will dictate your financial life for the next several years. If you don't understand the difference between simple interest and compound interest in the context of a short-term loan, you are at a massive disadvantage. We are going to dive into the math of the amortization schedule and show you exactly how much of your hard-earned money is going toward the repair versus the lender's pocket. But first, there is a specific clause found in nearly 70% of auto repair loan contracts that can cause your interest rate to double overnight without warning. Understanding this one paragraph can be the difference between a successful repair and a financial catastrophe. In the next section, we will deconstruct the fine print of the loan contract to expose the most dangerous clauses used in the industry today. The fine print of an auto repair loan is where the most significant financial shifts happen, often without the borrower realizing it until the first statement arrives. In 2026, the complexity of these contracts has reached a peak, with many digital agreements hiding critical clauses behind a series of "I agree" checkboxes. One of the most dangerous terms you will encounter is the universal default clause. Imagine a driver named Javier in Miami. Javier takes out a $2,500 loan to replace the electrical harness in his truck. He is diligent about his payments, but 3 months later, he forgets to pay a medical bill on time, which causes his credit score to dip. Because of the universal default clause in his auto repair loan, the lender has the right to hike his interest rate from 15% to 29%, even though he has never missed a payment on the car repair itself. This is a common practice in the subprime lending market, where lenders use any sign of financial instability to maximize their yield. Historical trends show that these clauses are often buried in a section titled "Changes to Your Terms." To identify this, you must look for language that mentions the lender's right to adjust the annual percentage rate based on your overall creditworthiness or performance on other obligations. This turns your auto repair loan into a volatile financial instrument. If you are in a situation where your credit is already on the edge, this clause can create a downward spiral. Case studies of borrowers in high cost of living areas like San Francisco or New York show that once these rates spike, the monthly payment often becomes unsustainable, leading to a default on the repair loan and eventually, a hit to the borrower's ability to secure any future credit. Another predatory mechanism is the pre-computed interest method. Most standard bank loans use the simple interest method, where interest is calculated daily based on the remaining principal. If you pay a simple interest loan off early, you save money. However, many specialized auto repair lenders use pre-computed interest. In this scenario, the lender calculates the total interest you would owe over the entire life of the loan on the very first day and adds it to your principal. Imagine if Javier decided to pay off his $2,500 loan 6 months early. With simple interest, he might save $200 in interest. With pre-computed interest, he still owes the full amount of interest as if he had kept the loan for the full term. This is effectively a hidden prepayment penalty. You should always scan your contract for the words rule of 78 or pre-computed interest. If you see them, you are entering a contract where the lender is protected against your early success. Now, let us examine the specific data regarding origination fees and documentation charges. In 2026, it is not uncommon for a $3,000 repair loan to carry a 5% origination fee. That is $150 tacked onto your balance before you even leave the repair shop. While this may seem small compared to the total bill, you are paying interest on that fee for the duration of the loan. Step by step, here is how that math works against you. If your loan is at 24% interest over 36 months, that $150 fee actually costs you over $220 by the time the loan is paid off. This is why you must ask for a Truth in Lending Act disclosure, often called a TILA box. This is a federally mandated table that must clearly state the finance charge, the amount financed, and the total of payments. If the total of payments is significantly higher than the repair estimate, you are seeing the cumulative effect of these fees and high interest. Consider the character of Maya in Denver. Maya is offered a $4,000 loan for a transmission replacement. The service advisor highlights the low monthly payment of $140. However, when Maya looks at the TILA box, she sees the total of payments is $5,040. She realizes she is paying over $1,000 in interest and fees for a $4,000 repair. By calculating the percentage of the loan that is going toward interest, in this case 25%, Maya can see the true weight of the debt. Historical data suggests that when consumers are presented with the total of payments rather than just the monthly payment, they are 40% more likely to seek alternative financing or negotiate the repair cost. We also need to discuss the arbitration clause. This is a paragraph that exists in nearly 85% of third-party auto repair loan contracts. By signing, you waive your right to sue the lender in a court of law or participate in a class action lawsuit. If the lender engages in predatory practices or makes a mistake on your account that ruins your credit, you are forced into private arbitration, a process that historically favors the lender. In 2026, this has become a major hurdle for consumer protection. If you find an arbitration clause, look for an opt-out provision. Some contracts allow you to opt out of arbitration if you send a written notice within 30 days of signing. This is a small step that preserves your legal rights in the event of a dispute. Furthermore, let us look at the payment allocation. Some lenders structure their contracts so that any extra payments you make are applied to future interest rather than the current principal. This is a sophisticated way of ensuring the loan lasts as long as possible. If you send an extra $50 to pay down your loan faster, you must specify in writing that the funds should be applied to the principal balance. Without this instruction, the lender may simply hold the money as a credit against your next month's payment, which does nothing to reduce the total interest you will pay. Case studies from consumer credit advocates show that borrowers who don't understand payment allocation end up paying 15 to 20% more over the life of the loan than those who proactively manage their principal reduction. Another clause to watch out for is the cross-collateralization clause. This is particularly relevant if you get a repair loan from the same credit union or bank where you have your primary car loan or a savings account. This clause states that your car, or even the money in your savings account, acts as collateral for the repair loan. If you default on the repair loan, the bank could potentially repossess your car even if you are current on your main auto loan. In 2026, as more people consolidate their finances into single-app ecosystems, the risk of cross-collateralization has increased. You must ensure that your repair loan is truly unsecured, unless you are prepared to put your entire vehicle on the line. To navigate these traps, you need a document review strategy. Step 1. Demand a physical or PDF copy of the full contract before you sign. Step 2. Use the search function to look for the keywords arbitration, default, precomputed, and collateral. Step 3. Compare the total of payments to the actual repair cost. Step 4. Ask the lender specifically how extra payments are handled. If the answers are vague, it is a sign that the loan is designed to extract maximum profit from your situation. Imagine if you could avoid these contracts entirely by using a specialized credit card with a 0% introductory period. While these also have risks, the terms are often more transparent than the bespoke loans offered at the mechanic's desk. However, there is a catch. If your credit score is below a certain threshold, you might only qualify for what is known as a subprime repair loan. These are the most dangerous products in the market, often featuring interest rates that exceed 35%, and including clauses that allow the lender to install a remote kill switch on your vehicle. If you miss a payment, they can literally disable your car from their office. This technology is becoming more common in 2026, and it represents the ultimate leverage for the lender. As we move into the next phase of this masterclass, we have to address the most critical question of all. Is the car actually worth fixing? Many people take out these high-interest loans for vehicles that are nearing the end of their mechanical life. This creates a situation where you are still paying off the repair loan long after the car has been sold for scrap. We are going to dive into the data-driven methods for determining your vehicle's break-even point. We will look at how to calculate the cost per mile of a repair, and how to use that data to decide if you should sign the loan or sell the car. But before we get there, you need to understand the hidden impact these loans have on your insurance premiums. Most people don't realize that taking out a high-interest repair loan can actually cause your car insurance rates to skyrocket. In the next part, we will uncover the link between your credit-based insurance score and your repair financing, and why your mechanic might be accidentally making your insurance more expensive. The connection between your auto repair loan and your car insurance premium is one of the most overlooked financial traps in the modern automotive landscape. In 2026, insurance companies have become incredibly sophisticated with their data modeling, moving far beyond your driving record to determine what you pay every month. This brings us to a critical concept you must understand before signing that loan document: the credit-based insurance score, or CBIS. While you might think that taking out a loan to fix your car is a responsible move to stay on the road, your insurance company's algorithm might see it as a signal of high-risk behavior. Imagine a driver named Carlos in Austin, Texas. Carlos owns a 2021 electric sedan that suddenly requires a battery thermal management system repair costing $4,800. Carlos doesn't have the cash on hand, so he accepts the financing offer at the dealership. The lender performs a hard inquiry on his credit, and because the loan is for the exact amount of the repair, Carlos now has a new credit line that is 100% utilized. On the surface, Carlos is happy because his car is fixed. However, 3 months later, his auto insurance policy comes up for renewal. To his shock, his premium has increased by 25%, despite him having a clean driving record for the last 5 years. Carlos is a victim of the invisible link between credit utilization and insurance risk. In the United States, historical trends show that nearly 95% of auto insurers use credit-based insurance scores in states where it is legally permitted. These scores are not the same as your FICO score, but they rely on the same underlying data. Insurers have found a statistical correlation between financial stability and the likelihood of filing a claim. From their perspective, a consumer who suddenly takes out a high-interest, high-utilization loan for an emergency repair is statistically more likely to experience future financial distress, which historically leads to a higher frequency of insurance claims. In 2026, with AI-driven underwriting, these adjustments happen almost in real time. By taking that repair loan, Carlos didn't just commit to a monthly interest payment. He inadvertently triggered a surcharge on his insurance that could last for the next 3 to 5 years. Let us look at the data-driven reality of this situation. Case studies from consumer advocacy groups have shown that in certain states, a significant drop in a credit-based insurance score can impact your premium more than a speeding ticket or even a minor at-fault accident. If your repair loan causes your credit score to dip by 30 or 40 points due to the hard inquiry and high utilization, you are facing a double whammy. You are paying the lender 15 to 24% interest, and you are paying your insurance company an extra $40 to $60 every single month. When you add those two costs together, the real annual percentage rate of your repair could effectively jump from 20% to over 40%. This is the hidden cost of capital that the mechanic will never mention because they likely do not even know it exists. To navigate this, you need to follow a step-by-step mitigation strategy. First, before you apply for any repair loan, you must check if you live in a state that prohibits or limits the use of credit scores in insurance underwriting. As of 2026, states like California, Hawaii, and Massachusetts have strict regulations against this practice. If you live in one of these states, your primary concern is the interest rate of the loan itself. However, if you live elsewhere, you must be much more strategic. Step 2 is to evaluate the type of credit being offered. A personal loan from a credit union is often reported differently than a retail credit card. In many cases, a fixed-term personal loan has a less negative impact on your credit-based insurance score than a maxed-out revolving credit line. Step 3 involves the timing of your application. If you know your insurance policy is set to renew in the next 30 days, you might want to explore alternative ways to fund the repair or wait until after the renewal is processed to take out the loan. This prevents the new debt from appearing on your report during the insurer's look-back period. Step 4 is to ask the lender for a soft pull pre-qualification. In 2026, many fintech lenders offer this, which allows you to see your rate without a hard inquiry hitting your credit report. While the final loan will eventually appear on your report, avoiding the initial hard inquiry can save you a few precious points on your score during that critical insurance renewal window. Consider another scenario with a character named Jasmine in Charlotte. Jasmine needs a $3,000 transmission repair. Instead of taking the high-interest shop loan, she uses a combination of a small personal savings amount and a low-interest personal loan from her bank. Because the loan amount is small relative to her total available credit, her credit utilization remains low. When her insurance renews, her premium stays flat. By understanding the CBIS, Jasmine saved herself over $700 in insurance surcharges over the next 2 years. This is the level of depth you need to apply to every financial decision involving your vehicle. Furthermore, we must discuss the impact of the vehicle's age and the loan's duration on your insurance requirements. Many lenders, especially those providing larger repair loans, may require you to maintain full coverage insurance, including comprehensive and collision, as a condition of the loan. If you were previously driving an older car with only liability coverage to save money, the loan could force you into a much more expensive insurance tier. Imagine if your liability-only insurance was $80 a month, but the lender requires full coverage that costs $200 a month. That is an extra $120 every month added to the cost of your repair. Over a 36-month loan, that is over $4,000 in extra insurance costs that you wouldn't have had if you had paid for the repair in cash or through an unsecured loan that didn't have insurance mandates. This leads us to a vital calculation: the total cost of ownership post-repair. You must add the monthly loan payment, the projected interest, and the potential insurance increase to see the true monthly impact on your budget. If the sum of these three numbers exceeds your monthly car payment for a newer, more reliable vehicle, you are making a mathematically unsound decision. In 2026, the threshold for this is getting lower as used car prices stabilize and repair labor rates continue to climb. We also need to look at how these loans affect your ability to switch insurance providers. If you are locked into a repair loan that requires specific insurance limits, you lose your leverage to shop around for a better rate. You become a captive customer. Insurance companies know this, and they have very little incentive to offer you competitive pricing when they know you are contractually obligated to maintain a high level of coverage. Historical trends show that borrowers with active repair loans stay with their current insurers 20% longer than those without such debt, often paying a loyalty penalty in the process. As we continue this masterclass, we are going to pivot from the external costs of the loan to the internal value of the vehicle. This is where most people make their biggest mistake. They fall into the sunk cost fallacy, believing that because they have already spent money on the car, they must keep spending to protect that investment. But a car is not an investment. It is a depreciating utility. We are going to look at the exact formula you should use to determine if your car is a financial zombie, a vehicle that is technically alive but eating your entire financial future. We will explore how to calculate the diminishing returns of a repair and why the current year 2026 is a unique turning point for vehicle valuations. But before we get into the math of the car's value, there is one specific type of repair that you should almost never finance, no matter how low the interest rate is. Financing this one thing is the fastest way to find yourself underwater on a loan for a car that doesn't even run. In the next part, we will reveal what that repair is and the data that proves it is a losing bet every single time. The repair that you should almost never finance regardless of how attractive the interest rate appears, is a catastrophic engine or transmission failure on a high-mileage vehicle that has already exceeded its expected service life. In the industry, we call this chasing bad money with good debt. Imagine a driver named Robert in Detroit. Robert owns a 2014 full-size pickup truck with 198,000 miles on the odometer. The truck is paid off, which Robert considers a win for his monthly budget. However, the transmission finally gives up the ghost. The quote for a remanufactured unit, including labor and a limited warranty, is $6,000. Robert looks at the used car market in 2026 and sees that a similar truck in good working order is only worth about $8,000. Because he doesn't have the cash, he is tempted by a 4-year repair loan at 18% interest. If Robert signs that loan, he is making a catastrophic mathematical error. Over 48 months, his $6,000 repair will actually cost him over $8,500 once interest is factored in. He is effectively paying more for a single repair than the entire vehicle is worth. This is the definition of being underwater on a repair loan. Historical trends show that vehicles with over 150,000 miles have an exponentially higher probability of a secondary major component failure within 12 months of a primary repair. If Robert's engine or fuel system fails 6 months from now, he will still owe nearly the full balance of the transmission loan on a truck that is now worth $0 as a non-runner. This is a debt trap that creates a financial anchor, preventing Robert from being able to afford a replacement vehicle when he inevitably needs one. To avoid this, you must understand the 50% rule. Case studies from automotive economists suggest that if a single repair cost exceeds 50% of the vehicle's current fair market value, the vehicle has reached its economic end of life. For Robert, a $6,000 repair on an $8,000 truck represents 75% of its value. Step by step, the calculation should look like this. First, check the private party value of your vehicle in its current broken state. Usually, this is about 20 to 30% of its functional value. Second, check the value if it were fixed. Third, subtract the repair cost from the fixed value. If the result is less than what you could get by simply selling the broken car for parts and adding the money you would have spent on the loan to a down payment for a newer car, the repair is a losing proposition. In 2026, the data indicates that the average age of cars on American roads has reached an all-time high of nearly 13 years. This means more people than ever are facing the dilemma Robert is in. Lenders are aware of this and have designed specific products to target these high-mileage owners. These loans often feature balloon payments or extended terms that outlast the mechanical viability of the car. If you are financing a repair for 36 months, but the car is likely to only last another 18 months, you are setting yourself up for a period where you are paying for a ghost. You are essentially paying a car payment for a vehicle that is sitting in a scrapyard. Consider another scenario with a character named Linda in Seattle. Linda has a 10-year-old European luxury sedan. These vehicles are notorious for high maintenance costs as they age. Linda's car needs a complex suspension overhaul and an oil leak repair, totaling $4,500. The car's value is roughly $7,000. The shop offers a low-interest promotional loan. Linda thinks this is a great deal until she realizes that the specific parts being replaced are prone to failure again in 30,000 miles. By financing the repair, she is not just fixing the car. She is subsidizing a design flaw with her future earnings. Historical data on European luxury imports suggests that once they hit the 10-year mark, the annual cost of maintenance often exceeds the cost of a lease on a brand-new, entry-level vehicle. This brings us to the third thing you must know: the concept of the opportunity cost of credit. Every dollar of your credit limit that is tied up in a repair loan is a dollar you cannot use for other emergencies or investments. If Linda uses $4,500 of her borrowing capacity on a depreciating German sedan, she may not be able to access credit if her home's HVAC system fails, or if she has an unexpected medical expense. In 2026, where credit tightening is a common occurrence in the banking sector, preserving your available credit is a strategic necessity. Taking out a repair loan is a consumption of your future liquidity. Furthermore, we must look at the impact of the repair on the vehicle's resale value. Most people assume that spending $6,000 on a new transmission adds $6,000 to the value of the car. This is a myth. In reality, a functioning transmission is the baseline expectation for any buyer. Having a new one might make the car easier to sell, but it rarely increases the price significantly above the market average. Case studies from major online car retailers show that a vehicle with a recent major repair often sells for only 5 to 10% more than a vehicle with an original, functional part. You are spending 100% of the repair cost to gain 10% in equity. That is a 90% loss on your investment from day one. To navigate this, you need to use a data-driven approach to part sourcing if you absolutely must repair an older vehicle. Instead of a $6,000 remanufactured transmission, you might look for a used unit from a low-mileage salvage vehicle, which could cut the cost in half. However, many lenders will not finance repairs that use used parts. They require the use of new or certified remanufactured components to protect their interest in the collateral. This is another way the loan itself forces you into a more expensive, less rational financial decision. If the only way you can afford the repair is through a loan that mandates the most expensive parts, the loan is actively working against your best interests. Imagine if you took the monthly payment you were prepared to give to the lender, say $250 a month, and instead looked at what that could buy in the used car market with a trade-in of your current broken vehicle. In 2026, there are numerous reliable, high-efficiency vehicles that can be had for a monthly payment similar to a high-interest repair loan. The difference is that the newer vehicle comes with a fresh slate of reliability and, often, a remaining factory warranty. You are trading a debt for an asset, rather than adding debt to a liability. We also have to consider the psychological impact of the never-ending repair cycle. When you finance a repair, you are emotionally committed to that vehicle. When the next thing breaks, you feel obligated to fix it because you still owe $3,000 on the last repair. This is how people end up spending $15,000 over 3 years on a car that is only worth $5,000. They are trapped by their own financing. The data shows that borrowers with active repair loans are 60% more likely to approve subsequent repairs they can't afford, simply to justify the original loan. As we move forward, we need to talk about the alternative to these traditional loans. There are ways to fund a repair that don't involve 24% interest or predatory fine print. We are going to explore the world of manufacturer assistance programs, hidden warranties, and the specific ways you can leverage your insurance policy to cover mechanical failures that you might think are out-of-pocket expenses. But before we get to those solutions, there is one more trap we have to uncover. It is a trick used by service advisors to make the loan seem cheaper than it actually is by manipulating the shop supplies and labor times. In the next part, we will show you how to audit your repair bill like a pro to ensure you aren't financing air and grease. We will also dive into the legal rights you have when a financed repair doesn't actually fix the problem, a scenario that happens more often than the industry wants to admit. The fourth pillar of this masterclass is the meticulous auditing of the repair bill itself, because in 2026, you aren't just financing parts and labor. You are often financing air, grease, and administrative inefficiency. When you agree to an auto repair loan, every single dollar added to the invoice is amplified by the interest rate. If you are financing a $3,000 repair at 24% over 3 years, a hidden $50 fee doesn't just cost $50, it costs nearly $85 by the time the loan is retired. This is why you must treat the repair order with the same scrutiny a forensic auditor treats a corporate balance sheet. Imagine a driver named Kevin in Indianapolis. Kevin's car needs a new steering rack. The shop provides a quote for $2,200 and offers a convenient payment plan. When Kevin looks at the line items, he sees a charge for $180 labeled shop supplies. When he asks what that covers, the advisor vaguely mentions rags, brake cleaner, and floor mats. In reality, historical trends in the automotive service industry show that shop supplies are often calculated as a percentage of the labor cost, capped at a certain amount, regardless of how many supplies were actually used. By financing this, Kevin is essentially paying interest on a standardized markup. To protect yourself, you need to follow a step-by-step auditing protocol. Step 1. Request the labor time for every specific operation. Mechanics use databases like AllData or Mitchell 1 to determine how many hours a job should take. If the shop is charging you 4 hours for a water pump that the database says takes 2.5, they are inflating the labor. Step 2. Check the parts markup. It is common for shops to charge 2 to 3 times the wholesale price of a part. While some markup is necessary for the shop to stay in business and provide a warranty, an excessive markup financed through a high-interest loan is a recipe for financial ruin. Step 3. Identify overlapping labor. If a mechanic is replacing your timing belt, they already have the front of the engine disassembled. If they also charge you full labor for a water pump, which is located behind that belt, they are double charging you for the disassembly time. Case studies of consumers who challenged these overlapping labor charges show potential outcomes where the total bill was reduced by 15 to 20% before the loan was even signed. For Kevin, identifying that the shop supplies and overlapping labor were inflated reduced his $2,200 bill to $1,850. Over the life of his 3-year loan, that $350 reduction saved him over $500 in total payments. This is the power of being an informed borrower. You are not just negotiating a price. You are negotiating the principal of your debt. Furthermore, we must address the legal nightmare that occurs when a finance repair fails. In 2026, the complexity of vehicle electronics means that many repairs are actually just educated guesses. Imagine if Kevin spends $2,200 on that steering rack, but the noise in his steering remains. He still owes the finance company $2,200, but his car isn't fixed. Most repair loans are sold to third-party financial institutions. This means the bank that owns your debt has no legal responsibility for the quality of the mechanic's work. They want their monthly payment regardless of whether your car is running or sitting in your driveway as a lawn ornament. This is where the holder in due course rule and the FTC preservation of consumers' claims and defenses rule become your primary weapons. Under federal law, if a loan contract contains a specific notice, you may have the right to assert the same legal claims against the lender that you have against the mechanic. However, many specialized automotive credit cards and buy now, pay later apps attempt to circumvent these protections through their terms of service. You must verify if your loan is a direct loan from a bank or a retail installment contract. Historical data suggests that borrowers with retail installment contracts have slightly better leverage in these disputes than those with independent personal loans, as the contract is directly linked to the specific service provided. If the repair fails, you must follow a strict documentation trail to protect your credit. Step 1. Do not stop making payments on the loan. Defaulting will ruin your credit score and potentially lead to a lawsuit or repossession, even if the repair was botched. Step 2. Return the car to the shop immediately and demand a correction under the repair warranty. Step 3. If the shop cannot or will not fix it, obtain a second opinion from an ASE-certified master technician at a different facility. Step 4. File a formal dispute with the lender, including the second opinion and photos of the failed work. In 2026, many lenders have a dispute resolution department specifically for these scenarios. They can occasionally place a temporary freeze on interest accumulation while the dispute is investigated. Now, let us look at the character of Maria in San Antonio. Maria financed a $3,000 engine repair. 2 weeks later, the engine seized because the mechanic forgot to tighten an oil drain plug. The shop went out of business the following week. Because Maria had a high-interest third-party loan, she was still on the hook for the $3,000 plus interest for a dead engine. This is a catastrophic scenario that happens more often than consumers realize during economic shifts. To mitigate this risk, you should always check the shop's garage liability insurance and their rating with the Better Business Bureau before signing a loan. A shop that isn't willing to provide proof of insurance is a shop you should never finance a repair with. Another critical data point is the use of remanufactured versus used parts in financed repairs. Lenders often have strict requirements for the type of parts used to ensure the vehicle remains viable collateral. However, many shops will charge you the price of a new OEM part while installing a cheaper aftermarket or white label part. If you are financing the higher price, you are being defrauded. Step by step, you should verify the part numbers on your final invoice against the parts actually installed on the car. You can often see the labels on larger components like alternators, starters, or radiators. If the numbers don't match, you have grounds to renegotiate the loan amount. Imagine if you could avoid the stress of a failing repair by using a credit card that offers purchase protection or extended warranty benefits. While most people think these benefits only apply to electronics or clothes, some premium cards in 2026 have expanded their protections to include professional services like auto repair. However, these benefits are almost never available if you use the shop's in-house financing. This is yet another reason why the type of money you use matters just as much as the amount. We also have to consider the impact of the technician's skill level on your loan. In many franchise shops, the work is performed by entry-level C-techs, while you are being charged A-tech labor rates. If you are financing a complex diagnostic or an engine rebuild, you should insist that a master technician performs the work. You are paying a premium for the financing, you should receive a premium level of service. Case studies show that repairs performed by higher-tier technicians have a 40% lower comeback rate, meaning you are less likely to end up in a dispute with your lender over a failed repair. As we move toward the final sections of this masterclass, we need to address the fifth and final thing you must know: the exit strategy. Most people focus on getting into a loan, but very few people have a plan for getting out of it early. We are going to explore the world of debt restructuring, how to use balance transfer offers to escape high-interest repair loans, and the specific ways you can use 2020 SIXS tax laws to potentially deduct some of these costs. But before we get there, we need to talk about the free loan trap. This is a marketing tactic that has exploded in the last year, promising zero interest with no credit check. Sounds too good to be true because it is. In the next part, we will expose the predatory mechanics of the no credit check repair loan, and how they use your car's GPS data to ensure they always get paid, even if you can't afford to eat. The no credit check auto repair loan is the ultimate wolf in sheep's clothing in the 2026 financial marketplace. To a driver in a crisis, it looks like a miracle. To a financial analyst, it looks like a sophisticated trap designed to exploit the desperate. When a shop advertises that your job is your credit or no credit needed, they are not being generous. They are pivoting to a high-risk lending model where the collateral is not just your car, but your ability to function in modern society. In 2026, this is powered by a technology known as the payment assurance system, or more colloquially, the remote kill switch. Imagine a driver named Marcus in Las Vegas. Marcus works as a rideshare driver, and his vehicle is his only source of income. When his air conditioning compressor and cooling fan fail in the middle of a triple-digit heat wave, he faces a $2,400 repair bill. Marcus has a low credit score due to past student loan issues, so he gravitates toward a shop offering no credit check financing. The process is suspiciously fast. He provides a pay stub, a utility bill, and access to his bank account for automatic withdrawals. What he doesn't fully grasp is that as a condition of the loan, the shop installs a small electronic device behind his dashboard. This device is linked to his loan account via a cellular connection. Historical trends in the subprime automotive sector show that these devices serve three functions: GPS tracking, starter interruption, and audible payment reminders. If Marcus is even 24 hours late on a weekly payment, the lender can send a signal to the device that prevents the engine from starting. Imagine Marcus waking up at 5 in the morning to start his shift, only to find his car is a dead piece of metal because a banking glitch delayed his transfer by 1 day. Case studies of this technology show that it is often used aggressively, with some lenders charging a reactivation fee of $50 to $100 just to turn the car back on after a late payment is resolved. By financing through a no credit check provider, Marcus has essentially given a third party a digital key to his livelihood. The data regarding the cost of these loans is staggering. Because there is no credit check, the lender assumes a high rate of default and prices the loan accordingly. In 2026, it is not uncommon to see effective annual percentage rates on these products exceeding 150% when all fees are included. Let's look at the math for Marcus's $2,400 repair. The loan is structured as a weekly payment of $85 over 12 months. At first glance, $85 a week feels manageable for a working driver. However, $85 times 52 weeks equals $4,420. Marcus is paying $2,020 in interest and fees for a $2,400 repair. That is an effective interest rate that would be illegal in many other lending sectors. But because it is often structured as a retail installment sale or a lease-to-own agreement on the parts, it frequently bypasses state usury caps. Furthermore, we must look at the bank account access. These lenders almost always require an automated clearinghouse, or ACH authorization. This gives them the right to pull funds directly from your account on a set schedule. In 2026, some of these contracts include a split payment clause, where the lender can attempt to withdraw smaller amounts multiple times a day if the full payment isn't available. If Marcus has $40 in his account and the lender tries to pull $85, his bank might charge him a $35 overdraft fee. If the lender tries 3 times in 1 day, Marcus could face over $100 in bank fees on top of his loan payment. Historical data suggests that borrowers using no credit check repair loans are 4 times more likely to experience a bank account closure due to excessive NSF fees than those using traditional personal loans. Step by step, here is how you should evaluate a no credit check offer if you feel you have no other choice. Step 1. Ask specifically if a GPS or starter interrupt device will be installed. If the answer is yes, you must factor in the risk of being stranded. Step 2. Calculate the total of all payments. Do not listen to the weekly or bi-weekly number. Multiply the payment by the number of weeks in the term. Step 3. Check for a voluntary surrender clause. Some of these contracts state that if you cannot pay, the lender can take the car, sell it at a private auction for a fraction of its value, and still sue you for the remaining balance of the repair. Step 4. Look for the right to recalculate clause. In 2026, some high-risk lenders include terms that allow them to increase your payments if their internal risk model for your geographic area changes. Let's consider an alternative scenario with a character named Chloe in Nashville. Chloe is in a similar situation to Marcus, but decides to investigate a second-chance credit union loan instead of the shop's no-credit check offer. Even with a poor credit score, the credit union offers her a credit builder repair loan at 18% interest. Her monthly payment is much lower, and there is no kill switch on her car. By avoiding the predatory no-credit check market, Chloe preserves her dignity and her bank account. The primary difference between Marcus and Chloe was 15 minutes of research and the willingness to walk away from a too-easy offer. The fifth thing you must know is the parts-only loophole. Some of the most aggressive lenders in 2026 don't actually finance the labor, they only finance the parts. They purchase the parts from the shop and lease them to you. Because it is a lease, they can claim they aren't subject to lending laws. If you stop paying, they aren't just repossessing a car, they are technically repossessing their transmission or their engine. While it is physically difficult to repossess a transmission, they use the threat of the kill switch and legal action to force compliance. Case studies show that consumers in these lease-to-own arrangements often end up paying 3 to 4 times the retail price of the parts. We also have to discuss the impact of these loans on your future mobility. If you are locked into a high-interest no-credit check loan, you are effectively stuck with that car. You cannot trade it in because the payoff amount of the repair loan is often higher than the value of the car. In 2026, where vehicle technology is moving fast, being trapped in an old, unreliable car with a $5,000 repair debt is a form of financial paralysis. You are paying for yesterday's breakdown with tomorrow's potential. This leads us to a critical realization. The convenience of these loans is a product being sold to you, just like the car parts. Lenders spend millions of dollars on psychological profiling to understand how to make a predatory loan feel like a helpful hand. They use warm colors in their apps, friendly language in their texts, and they emphasize keeping you on the road. But the data doesn't lie. High-interest, no-credit check loans are a leading cause of Chapter 13 bankruptcy filings in the United States. They are the final straw for many households already struggling with the cost of living. As we move into the final stages of this masterclass, we are going to look at how to break the cycle. If you are already in one of these loans, there are specific legal and financial steps you can take to mitigate the damage. We will talk about refinancing the repair, how to use goodwill adjustments from manufacturers, and the secret world of technical service bulletins that could get your repair covered for free, even if your car is out of warranty. But before we get to the solutions, there is one last hidden fee that can pop up at the very end of your loan. It's called the lien release fee. And if you don't know how to handle it, you might find that you don't actually own your car even after the final payment is made. In the next part, we will expose the end-of-loan traps that catch even the most diligent borrowers. The end of an auto repair loan is supposed to be a moment of relief, a return to financial breathing room after months of sacrifice. However, in 2026, the final payment is often just the beginning of a new set of complications known as the residual lien trap. Most consumers assume that when their balance hits zero, the lender's interest in their vehicle evaporates automatically. This is a dangerous misconception. In many states, especially those with paper-based title systems still lingering alongside new digital registries, a lien remains on your vehicle until a formal release is filed with the Department of Motor Vehicles. If this is not handled correctly, you could try to sell or trade in your car 2 years from now, only to discover that you technically do not have a clear title. Imagine a driver named Sarah in St. Louis. Sarah spent 18 months paying off a $4,000 engine repair loan. She made her final payment in early 2026 and received a congratulatory email from the lender. 3 months later, she decides to trade her car in for a newer hybrid. The dealership runs the vehicle identification number and informs Sarah that there is still an active lien from the repair finance company. Because the repair lender is a smaller, third-party fintech firm that was recently acquired by a larger bank, the customer service line is a maze of automated prompts. Sarah is stuck. She cannot sell her property because a ghost of a debt she already paid is haunting her title. Historical trends show that roughly 15% of non-bank auto repair loans result in some form of lien release delay or error. To avoid this, you must follow a proactive end-of-loan protocol. Step 1. 30 days before your final payment, call the lender and ask for the specific procedure for lien satisfaction in your state. Step 2. Once the final payment clears, demand a physical lien release or a satisfaction of mortgage document. Do not settle for a simple balance is zero statement. Step 3. Verify with your local DMV that the lien has been cleared in their electronic system. In 2026, many states have moved to ELT, or electronic lien entitling, but errors in data transmission between private lenders and state databases are remarkably common. Step 4. If your state still issues paper titles, ensure you receive a new, clean title that does not list the lender. Case studies of persistent lien errors show that resolving these issues years after the fact, when the original repair shop may have closed or the lender has changed names, can take months of legal back and forth. But there is another, more immediate trap at the end of these loans: the automatic renewal or service add-on. Many high-interest repair loans are bundled with roadside assistance, mechanical breakdown insurance, or maintenance plans that have a different term length than the loan itself. When the loan is paid off, the lender may continue to pull a smaller amount from your bank account for these secondary services. Because the amount is much smaller, perhaps $29 instead of $200, many borrowers don't notice it for months. In 2026, with the rise of subscription-based services, this has become a significant revenue stream for lenders. You must review your bank statements and your original contract to ensure that every authorization you gave for ACH withdrawals is explicitly revoked once the principal and interest are satisfied. Now, let us examine the data regarding the credit score rebound. Many people take out these loans with the hope that it will help build their credit. However, if the lender is not a major bank or a well-integrated fintech, they may not report your positive payment history to all three major credit bureaus: Equifax, Experian, and TransUnion. They might only report to one, or worse, they might only report negative data like late payments. This means you took on all the risk and cost of a high-interest loan without receiving the primary benefit of credit building. Before you make your final payment, you should pull your credit reports to verify the loan is being reported accurately. If it isn't, you need to file a dispute while the account is still active and you have the lender's attention. Consider the character of James in Orlando. James used a Buy Now Pay Later app for a $1,500 break and suspension job. He paid it off in 4 installments as planned. However, the app treated each installment as a separate line of short-term credit. When James went to apply for a small business loan later in 2026, his credit report looked chaotic, with 4 closed accounts and multiple hard inquiries in a short window. This is a case study in how modern fragmented lending can damage your credit profile, even when you do everything right. Historical data on these types of microloans suggests they are often viewed by traditional mortgage and auto lenders as a sign of financial instability, rather than a sign of creditworthiness. Furthermore, we must discuss the final interest calculation discrepancy. Some lenders use a method called the daily balance method, which can result in a small amount of interest accruing between the time you receive your payoff quote and the time the lender actually receives your funds. If you send exactly the amount on your statement, you might still have a balance of $3.40. Because that balance is not zero, the account remains open. If you don't realize this, the lender might charge a late fee on that $3 the following month. By the time you notice, a $3 mistake has turned into a $60 late fee and a reported missed payment on your credit. Always pay $10 more than your final payoff quote and request a refund of the overage. This ensures the balance hits zero and stays there. This leads us to the broader strategy of refinancing the repair. If you are 6 months into a 36-month loan with a 24% interest rate, you should not simply wait for the end. In 2026, there is a vibrant market for personal loan consolidation. If your credit has improved because you've been making your repair payments on time, you might qualify for a consolidation loan at 12%. By moving the debt from a specialized repair lender to a traditional personal loan, you can cut your interest costs in half and eliminate the risk of a kill switch or a lien on your vehicle. Case studies of successful debt restructuring show that borrowers who refinance their auto repairs halfway through the term save an average of $400 to $800. Imagine if you had used that saved money to start a dedicated car maintenance fund. The goal of finishing a repair loan should not just be to stop paying the lender, but to ensure you never have to take out a similar loan again. We are entering an era where the cost of vehicle ownership is becoming a major driver of middle-class debt. By understanding the endgame of these loans, you transition from a victim of circumstance to a manager of your own mobility. You have navigated the diagnostic traps, the interest rate deceptions, and the fine print minefields. Now you must secure your victory by ensuring the title is in your hand and the lender is out of your life for good. As we move into the final part of this masterclass, we are going to synthesize everything we have learned into a single high-stakes decision matrix. We are going to reveal the hidden warranties that manufacturers keep in their back pockets, programs that could have paid for your repair in full if you had known the right words to say. We will look at how to leverage the 2026 right to repair laws to access cheaper parts and independent data that lenders try to hide. But most importantly, we are going to show you the one calculation that tells you exactly when it is time to stop repairing and start replacing, using a formula that accounts for the current inflation in the automotive market. This is the final piece of the puzzle that will determine whether your car remains a tool for your success or becomes the reason for your financial downfall. In the final part, we bring it all together for your ultimate roadmap to automotive and financial freedom. The synthesis of this entire masterclass comes down to one final, high-stakes realization. The auto repair loan is a bridge, but you must know if you are crossing into a sustainable future or a financial desert. To make this determination in 2026, you must utilize the final tool in our arsenal, which is the hidden warranty and goodwill adjustment search. Before you commit to a single dollar of debt, you must investigate whether the manufacturer is already aware of the defect that is currently draining your bank account. In the automotive industry, there is a phenomenon known as the secret warranty. These are not publicly announced recalls, but rather internal service bulletins that instruct dealerships to cover specific repairs for customers who complain loudly enough or who are aware of the bulletin's existence. Imagine a driver named Anthony in Philadelphia. Anthony's 2019 SUV has a failed electronic power steering rack, a $4,000 repair. The dealership offers him a high-interest loan. However, instead of signing, Anthony spends 20 minutes on the National Highway Traffic Safety Administration website and discovers a technical service bulletin, or TSB, regarding his exact steering issue. He also finds a case study from a consumer forum where owners in cold weather states were given a goodwill adjustment that covered 70% of the repair cost because the failure was linked to road salt corrosion, a known but non-recalled issue. By presenting this data to the service manager, Anthony reduces his out-of-pocket costs from $4,000 to $1,200. He no longer needs a massive loan. He can cover the balance with his existing savings. This is the power of information over interest. The data suggests that manufacturers allocate millions of dollars annually for goodwill adjustments to maintain brand loyalty. However, this money is never offered. It is only granted upon request. In 2026, as vehicles become more software dependent, these adjustments often cover glitches that a mechanic might otherwise try to fix with expensive hardware replacements. Step by step, your final audit must include a search for your vehicle's VIN on the NHTSA database, a thorough sweep of specialized owner forms for extended coverage or warranty extensions, and a direct, polite request to the manufacturer's regional corporate representative if the local dealer denies assistance. Historical trends indicate that persistence in this area results in partial or full coverage in approximately 15% of major component failures that occur just outside the standard warranty period. Now let us look at the ultimate decision matrix, the repair-to-value ratio. This is the formula that separates those who build wealth from those who stay trapped in a cycle of automotive debt. In 2026, the cost of a reliable used car has stabilized, but the labor rate for repairs has increased by 12% year over year. You must calculate your vehicle's monthly utility value. Take the total cost of the proposed repair plus the interest of the loan over the next 12 months. Divide that by 12. If that number is higher than the monthly depreciation and maintenance cost of a 3-year-old replacement vehicle, you are mathematically better off selling the car in its broken state and moving on. Consider the character of Elena in San Diego. Elena's car needs a $3,500 engine head gasket repair. The loan for this repair would cost her $320 a month for a year. However, her car is 12 years old and has a market value of only $5,000. If she fixes it, she has an old car with a new gasket. If she sells it for $2,000 as is and adds the $320 she would have spent on the loan to a monthly payment for a 2023 certified pre-owned vehicle, she ends up with a car that has a 3-year warranty and a much lower probability of another breakdown. Case studies show that drivers who move to a newer vehicle when repair costs hit the 40% threshold of the car's value report 60% higher satisfaction and 40% lower total transportation costs over a 5-year period. Furthermore, we must address the 2026 right to repair landscape. Federal and state-level legislation has recently forced manufacturers to release proprietary diagnostic data to independent shops. This means you are no longer a captive audience for the dealership's high-priced service department and their specific financing products. You can take your diagnostic code to a highly rated independent technician who can often perform the same repair for 30 to 40% less using high-quality aftermarket parts. If your repair bill drops from $3,000 to $1,800, your need for a high-interest loan may vanish entirely. The data is clear. Independent shops in the United States currently hold a 42% price advantage over dealerships for non-warranty work. But what if you are already in a loan and you realized halfway through this masterclass that it was a mistake? You need an exit strategy. This is the secret of the debt avalanche versus the debt snowball applied to automotive repair. If your repair loan is at 28% interest and your credit card is at 18%, every extra dollar you have must go to the repair loan principal first. Historical data on debt repayment shows that focusing on the highest interest rate first, the avalanche method, saves the average consumer over $1,100 in interest over a 3-year period. In 2026, many people use their tax refunds or work bonuses to buy out these high-interest repair loans early. You must ensure your lender does not have a prepayment penalty, as we discussed in Part 4, and then aggressively reduce that principal to stop the interest bleed. Imagine if you took the lessons from this 10-part masterclass and turned them into a lifelong strategy. You start by building a dedicated mechanical emergency fund that is separate from your general savings. Even $50 a month creates a buffer that prevents you from ever being at the mercy of a service advisor's clipboard. You learn to perform basic maintenance yourself, changing filters, monitoring fluid levels, to prevent the catastrophic failures that lead to these loans in the first place. You become a proactive owner rather than a reactive debtor. This journey has taken us through the psychology of the breakdown, the math of the APR, the traps of the fine print, the hidden costs of insurance, and the predatory nature of no-credit check lending. You now know more about the auto repair finance industry than 99% of the drivers on the road. You have the step-by-step instructions to audit a bill, the data to challenge a repair, and the case studies to guide your decisions. This is not just about a car, it is about your freedom. In an economy where mobility is a requirement for employment, your ability to manage the cost of that mobility is your most important financial skill. As we conclude this deep dive masterclass, remember that the most expensive loan is the one you take out in a state of panic. By watching this, you have removed the panic and replaced it with a plan. You have the leverage, you have the data, and most importantly, you have the choice. Whether you decide to sign that loan, negotiate the repair, or trade in the vehicle, you are doing it from a position of strength. The roadmap to automotive and financial freedom is now in your hands. The conversation doesn't end here. The automotive landscape is shifting daily with new technologies and new lending regulations. While we have covered the 5 critical things you must know, there is an entire world of vehicle equity management that most people ignore until it is too late. In our next deep dive series, we are going to explore the radical changes coming to the used car market in 2027 and how you can position yourself to never be underwater on a vehicle again, regardless of what happens under the hood. Stay tuned because the next level of your financial education starts the moment you turn the key.